If IAS 21 is talking about the treatment of transactions in foreign currency, then the question we then have to ask ourselves is, how do we recognize these transactions? So, initial recognition and then subsequent measurement. What happens is that it's very simple. At the date or the date on which the transaction takes place, we will translate the transaction in the foreign currency into the functional currency of the entity using the exchange rates at the date of the transaction. So initial recognition. The foreign transaction shall be translated into the functional currency of the entity using the exchange rate at the date of the transaction. Now, it depends on what we are buying. It depends on what kind of transaction we are dealing with. But whatever transaction it is, we are going to be passing our journal entry. We're going to be passing our journal entry. So whatever we bought, the journal entry is going to be passed. And we will get into how we're going to pass the journal entry in a moment so that you get a concept pretty well. So that is initial recognition. On the date of the transaction, we translate. On subsequent measurement, it's very important we know how the treatment is supposed to be done. So subsequent measurement. Stay with me carefully. On subsequent measurement, the treatment of the transaction would depend on whether the item is a monetary item or non-monetary item. And this is where it gets really interesting. So make sure you stay with me carefully here. So the subsequent measurement of items depends on whether they are monetary or non-monetary items. Stay with me carefully. So if they are monetary items, there is a way we're going to treat it. If they are non-monetary items, there is a way we're going to treat it. So let's start with non-monetary item. If it is a non-monetary item, on subsequent measurement, we just apply whatever accounting standard it is to be applied in relation to that particular item. So here we apply the respective IFRS to the element or to the item in order to determine its carrying amount. So if it is a property, plant, and equipment that we bought, on subsequent measurement, we're going to apply IAS 16. If it is an inventory we bought, on subsequent measurement, we will apply IAS 12. If it's an investment property, on subsequent measurement, we will apply IAS 40. So depending on whatever it is we dealt with, we are talking about, if it's a non-monetary item, the respective accounting standard will be applied. But if it is a monetary item like trade receivables, trade payables, other forms of liabilities, then we have to retranslate it at the reporting date using the exchange rate at the reporting date. Very important. That is, if it is still outstanding in the year or at the year ended. So where the amount is still outstanding, at the reporting date, it is retranslated using the exchange rate at the reporting date. And once we do that, any foreign exchange, any translation gain or loss is recognized in the P&L account. So any translation gain or loss is recognized in the profit or loss. Pretty simple. That is the idea about the subsequent measurement of the items. But there is a catch here. There are times where non-monetary items, although we are supposed to apply the respective IFRSs, there are times when the non-monetary items, their measurement will be based on the foreign currency. So although we are supposed to apply their respective accounting standards, if their subsequent measurement still is denominated in the foreign currency, then we will treat it as we will for monetary items. That's very important. So let me put that down, where the carrying amount of a non-monetary item is denominated in a foreign currency, its treatment will be like monetary items. Did you get that? So sometimes we have bought a property, plant, and equipment, and we are supposed to apply IAS 16 to it. But then on subsequent measurements, the property is revalued. And so it is revalued not in the functional currency of the entity, but in the foreign currency. So we need to retranslate it, and then any foreign exchange gain or loss will still be recognized in the P&L account. That is the idea about that.